following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the optionsinsider.com, as well as the old and ever-expanding and ever-entertaining Options Insider Radio Network. And I am joined today for this final Vol Views of 2012 by our returning cast of regulars, starting off with the man from the pit. Some folks call him Mr. Seabass himself, none other than Mark Sebastian from OptionPit.com. Mark, welcome to this final Volatility Views of 2012.
Happy birthday!
I see you've been watching some Christmas specials in your house.
Oh,
there.
Yeah. You know, I just put one foot in front of the other, and then I'm ready to go, you know? Soon I'm walking out the door.
That's a plan for every day. We haven't delved into the Frosty here yet. Maybe that might be something we do for this year. We've done the other ones, you know, Rudolph and whatnot, but for some reason never got around to Frosty. I'll have to add that to our list, I think.
That's a fun one.
That is a good one. A little sad at the end there, but then he comes back, so it's okay.
He does. He's made of Christmas, so did you know that?
Speaking of men who always come back, we are also joined by overcoming the Skype hurdles in his path by Don Schlesinger, the major domo over there at the Volatility Exchange. Don, welcome back to the show to you as well.
Well, glad to be able to be here. I opened up my Skype, and for some reason it was uncooperative, but just a minor glitch, and we're ready to roll.
Perfect timing, as always, sir. All right. With the gang all assembled, we're going to dive into our final volatility review for 2012.
It's time for the Volatility Review.
All right, and welcome to our Volatility Review. As I said, this is our final one for 2012, so we have to make it a good one. And there has indeed been a wee bit of activity. I suppose it depends on your definition of activity. We'll go to the Clintonian definition of is here on the show. But there has been a little bit happening. Of course, as we're recording today, there's a bit of movement on the street. All of the rumors coming out of Washington of the collapse of the impending deal on the old fiscal cliff have driven most of the major indices down about a little over 1% on the day today. And VIX cash ticking up about 6% to 18.71 right now. So perhaps we'll start there.
The hilarious thing is what happened last night, and I think that's what we need to address first.
Let's dive into it.
And let's discuss why you don't react. You know, it's one thing if you're a futures trader to kind of play the overnight game because there can be some money. But if you're a regular retail trader or somebody that's looking to hedge, you don't react in the overnight futures market. But futures at one point were limit down overnight. Futures, an S&P CME Group flash crash that happened in the futures where they dropped from basically unchanged to down 50 to down 20 in a matter of about 2 minutes. And then since then, you can see we basically settled where futures are down what? Let me take a look here. You know, we've got the S&P futures down 20 and about 20, which is about $16 in the cash index. You know, if you sold the bottom limit down, you are out 30 handles, X number of contracts, which is going to be a swift kick. So you traders, you need to be smart. People wonder why VIX futures don't trade 24/7. I would have loved to have gotten to sell a VIX future on the top of that S&P, because I can guarantee you it would have been the sale of the year, even better than that S&P vol sale. I'd imagine with the S&P's down 50, the VIX futures would have gone from, let's see, I think they closed yesterday at around 17. Probably would have printed like close to 30 and then come right back down to now they're trading a little over 18. That would have been a sale and a half.
I did see that, and do you know if all of that was attributed to just the massive rumor mongering coming out of Washington? Was there a glitch over on Globex as well?
Somebody pushed the sell button and forced everything down. It absolutely was.
Clearly.
I mean, basically...
More sellers than buyers.
My understanding is Boehner announced that they weren't going to have a vote. The futures went boom, crashed, and then popped back. And, now look, I mean, we're off $14 on the S&Ps. The VIX might close down on the day. And, it's just what's happening is incredible. The implied vol of S&P options last night traded over 30.
And that was the collective wisdom of what future volatility was going to be, right, Mark?
I had a feeling you might have an opinion on that, Don.
Well, I was trying to be quiet, trying to bite my tongue for as long as I could.
Don, for a man that made his fortune trading implied volatility, you really hate it, and I love it. So,
yeah,
and maybe the reason why you made your fortune trading implied vol is because you hate it so much.
Well, I always kind of thought, and it's really strange, but I almost kind of considered myself more a premium seller than trading implied volatility. And that might sound very strange to you, that I made the distinction. But there was that distinction in the sense that, I put out of the money strangles on and tried to stay delta neutral and trade within a particular range. But I also didn't adjust positions every day because it gets very costly to do that. And so I basically tried to withstand a little bit of pain to one direction or another if I didn't think there was going to be a sustained move. And I really kind of played market direction within a range more than I did implied volatility, so that I'm sure somewhere along the line there were many trades that I did when I sold a particular implied volatility, and when that number went up during the time that I held my position, and where I still made plenty of money nonetheless, simply because the out-of-the-money options expired worthless or close to worthless or whatever. But, what happened yesterday just continues to point out this dichotomy between potentially...
Don, may I just make a quick point and plug?
Yep. Yeah.
The method you just described in terms of a premium seller, much like an insurance company, if you will, and that's the exact nature and the subject of my book, The Option Trader's Hedge Fund, where we really discussed what we call our atomic approach, the one-man insurance company approach, where you're really not where you're selling insurance premiums.
Yep.
And there are a lot of people that are professional and non-professional that really do take that approach. So anyway, sorry, didn't mean to interrupt. Just wanted to.
I'm happy for that. And of course, we've said over and over again that you need deep pockets to do something like that, because untoward events are part of the landscape, and if they come up sooner rather than later, you've got to have enough ammunition to keep the lights on and stay in business. And it's something we've discussed often. But it was interesting yet again, and we've discussed this. I try to turn on at night around midnight or so, just kind of check the overnight futures to get a glimpse of what might happen the next day. And of course, I was a little bit unhappy to see as much red as I did last night. And the Dow futures were down 197 and the S&P about 22 handles when I checked in. And I realized it had to be because of this failed plan B that didn't materialize during the day. And then I kind of thought to myself, this looks like a 1.5% move. And the downside ratio when markets move 1.5%, VIX usually goes as much as 8 times that amount. So I did 1.5 times 8, it's a 12% move. Took a look at where VIX was last night at the close in the mid 17s, took my 12.5% of that, or 12%, and I said, VIX going to be up a little bit more than 2 handles on the opening. And then knee-jerk reaction, very dutifully, VIX opens up in the mid-19 handle, and basically we have that 11 to 12% move on the VIX futures. And then I'm listening to CNBC, and that's all I need to get my blood boiling. Oh, the VIX is up 2 handles as options traders are weighing in for increased volatility in the future.
Oh, God.
And
oh, Lord. Uh-oh.
Myself,
here comes a diatribe, folks.
Gee, aren't they a wise bunch? The market's down 200 on the Dow, 22 handles on the S&P. Options aren't open yet. The options then open, and VIX is up 2 handles, implied volatility is up 2 handles, and that's due to the collective wisdom of the options traders who, in their infinite clairvoyance, are foreseeing future volatility. It had nothing to do with the 200 points that the Dow was down or the 22 handles. It had to do with options traders opening up the S&P options and deciding that it was now time to predict future volatility in the markets.
That's also the collective wisdom, options wisdom, I should say, being filtered through an anchor at CNBC, and we know how much value they tend to add to the equation from an analytical perspective.
But now all of a sudden that prediction changed during the day, didn't it? That prediction is in the process of changing as we speak. So it has nothing to do with what the market is doing today, but they just decided they changed their mind about their prediction.
This is the time. This is the time of year when you have a hedge fund. You want to have 1 or 2 guys working on the hill for you, telling you, or at least have some of the staffers in your back pocket, because advanced news of these kind of deals coming out, it usually tends to be a valuable thing, especially if you're working after hours in the S&P.
Tell you, I think that we're pricing out for, a one day big move and then nothingness through the next 30 days.
Yeah, and I think you very well may be right. And if this thing does get resolved after the new year rather than before, well, we've already taken 1 chunk out today, and eventually there'll be some sort of deal struck. And I don't know that the markets will rejoice, but at least, they'll be stable again. Have to say, Mark, both you and I kind of probably missed the prediction for the week, because I was talking about low realized volatility and the prospect that it probably would ratchet up. And you mentioned that implieds were rather high and they'd probably go down. And here we are sitting a week later where both S&P and NASDAQ vol fell appreciably on a realized level, what the actual volatility was. And believe it or not, S&P is now in the single digits for trailing 1 month historical volatility.
Trailing 1 month. Yeah, I've got we're going to little rebound today. We're back near 12%.
Yeah,
but the spread, Don, I think the really important thing is the spreads between trailing and implied this is why I think we're looking at a 1 day move, because the spread between implied and realized, if you look at 10, 20, and 30 day, and kind of blend that into an average, you're looking at about 10% vol.
Yeah, because I have 3 month historical at 12.2. That's excluding today. They'll all bump up a little bit, not a great deal.
Right.
And 1 month at 9.73. That's the single digits I was talking about. So a blend is 10, 11ish or so. By whatever standards.
Yeah, and so what I'm right. 20-day vol is about 20 trading day vol is 9.74.
Yep.
So the spread between that and the VIX, the VIX is trading at almost a 100% premium to realized vol. So that is why I'm saying I think we have one big move in the can, and then an absolute tanking. And my second reason for that has to do with, VIX term structure is basically pointing toward, even though the VIX has been running up, the curve has remained almost uniform in the spreads between Jan, Feb, March, April, yada, 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 pointing toward a just sudden drop in implied volatility such that the forward contract ends up trading at a 1 to 2 point premium that we'd normally expect.
Yep.
You know what we need, Don? I think we need a realized vol contract on the NASDAQ to trade.
Don't feed the fire, sir. Don't wave the red flag in front of the bull.
We're going to have a question coming up where I'll talk about, the product of the year that almost was, but didn't quite get there.
I was going to say, I have to imagine there has to be a special category for the Volex products there.
Maybe that's a good segue into our next segment. First question.
I think that is indeed. See, Don, you don't even need me. You've learned this, got this hosting thing down, sir. You mastered the art of the segue. Well, that is indeed a fantastic segue into our listener mail segment, where you, the listener, get your final chance to chime in on the show for 2012.
Listener mail. Listeners write in.
All right, and welcome to the old mailbag. We get to dust it off one final time. This is always one of my favorite parts of the show. Not that I love the guests, too. Those are fantastic. But the mailbag, where you, the listener, get your chance to chime in, is always fun, because we get a chance to see what you guys are thinking about, and you get your chance to pick our brains a little bit. Speaking of picks, the first question comes in as a tweet from Doc Hudson. I love some of these Twitter handles. And he writes, what is your pick for the volatility trade / product / development of the year? And he probably should have put a little caveat in there with the parentheses and saying perhaps excluding Volex, everything else, because that's an obvious answer for that one for you. But Don, I know you're pretty excited.
I think that product's going to be the 2013 product.
Exactly.
Of the year.
That's got some
the 2012.
That's got some future potential.
I hope it's like the coming attractions in the movies. I've been talking about our bringing NASDAQ realized volatility futures and other products, options, perhaps ETPs, perhaps S&P based as well. I'm not only hopeful, but 99.9% certain, and sooner rather than later, that's the product for 2013. In the meantime, in terms of your volatility trade of the year, you guys have more details on this than I do. It's got to be that guy who bought umpteen gazillion VIX calls, right?
Yeah, the VIX Feb 70s, I believe it was, probably still resonates with me. Actually, while we're talking, let me look and see if those are still open. I'm assuming that they are. Not exactly a bid to hit on those strikes anymore. But yeah, the VIX, 20,000 still open on the VIX Feb 70. So yeah, that probably runs pretty high for me as the trade of the year, because that just embodies so much of what's wrong with VIX.
If you mean single dumbest trade of the year, then yes.
Yes, he doesn't specify quality, profitable trade. He just specifies, I think, the trade that resonated the most, and that certainly resonated with me, because that embodies just so much of what is wrong with VIX these days. The frame of reference, the way people understand it, the lack of context they have for trading it.
I don't know. I would say the other one that I would say is ridiculously stupid was when Apple vol flipped from a equity curve to a commodity curve, a la the technology boom of 1999 and 2000. That would be the other vol trade of the year, was the skew trade in Apple. That would be the other one I would think about in terms of stupid, ridiculous vol buying in upside calls, and vol selling in downside puts that probably shut down a lot of people on this tear back down.
I mean, Apple skew is always ridiculously bid, but at a couple points this year, it just got out of control.
Well, I mean,
you couldn't do verticals for credits, but it was pretty close.
You could collar for a credit for sure.
Yes, that's true. That's true.
You could collar with more room on the downside. I mean, you could collar with less room on the downside and more room on the upside for a credit. I mean, think about this, Don. We had Apple trading 600. You could buy the 580, 630 collar and get paid.
Wow.
I think we were talking.
That is how much they bid up the upside curve.
I think we were talking about it on Option Block at the time when it was trading around 630. You could have done the 600 6.5 collar for a credit, for a substantial credit. I recall
that is still good. That my loan credit in The Economist is saying that Apple skew was ridiculous.
That's something you can just take that, copy and paste that quote and put it on any given day, and it's probably going to be applicable.
Well, no, and you know what I said was, I'm not saying Apple isn't a $600 stock. What I'm saying is it's not a $600 stock right now. So those would be the two. I would say the ridiculous VIX buying and then the ridiculous Apple call buying. Interesting that both of our stupid vol trades of the year, calls.
Yeah, that's you're right. It's not some super overbid put somewhere, or maybe I guess you can put, maybe lifetime achievement award would be like, VIX tail puts, or not S&P tail puts, just as a generally overbid product. But that's almost too cliche to say that at this point.
Yeah, rolling the Talib carcass back out.
No, I don't want to go down that rabbit hole again. We've been getting a lot of emails still on that topic. I've been forwarding them to Don, because Don has more time to pursue this than I do, and he's been engaging in some spirited debates with people. But I think on the product/development side, I would have to say, obviously, Volex coming in 2013, so we have to kind of put them as an asterisk for right now because they haven't launched yet. But I think a late addition that we've been talking about a little bit on the show recently, it certainly is intriguing, are these new variance contracts.
Yeah.
I know, Don, they're very controversial for you, but they seem to be getting some life behind them.
Yeah, well, they're really interesting. The CBOE rolled these out the first time and decided that, hey, we're the CBOE, and despite the fact that that one OTC variance swap can be more valuable than all the contracts that trade on our exchange in a given day, we know better how this should be quoted than the OTC market. Well, needless to say, when they did not uniformly match their futures quotes to how it's quoted in the OTC market, the product failed. They have since last week relaunched the variance future. And it's now quoted in the same denomination as is traded in the OTC market. And so they're now, they've seen some volume, and, you have to, they've got this little calculator. The volume is essentially in raw Vega that is converted into kind of variance contracts. So they take a notional Vega and basically do some mathemataz, shingamadaz, and squaring the volatility that's trading and convert that into a volume. So consider like about, with the VIX around, with vol around 18, 1,000 notional Vega is going to be plus right around 100 contracts plus or minus, a few. And so, of the, so far CFE's been kind of swing and a miss on every other product besides VIX. This one is the first product they've had that at least is nominally, marginally, I would say so far where it's not resoundingly unsuccessful, which if you're CBOE is a success.
Damning with faint praise, sir. And, if you'd like to hear some a relatively insightful discussion, I think, given that they're so close to it, on some of the downfall of the original variance contract and the problems that went into it and what they were planning to do with the new one, I sat down with Jay Coway, the guy who runs the CFE. This is about a little over a year ago, probably now. You can find it on iTunes and our Options Insider Radio network feed. It's our Options Insider Radio program, which is the original Options podcast and our flagship interview program still. And they were relatively candid about the failures with that product and what they were working to do to fix it. So if you want to hear about some of the issues that went into that and some of the problems that unfolded with that contract, I suggest you search that out on the Options Insider or in iTunes or in Stitcher. You can find that program.
And I'll say that I think, believe it or not, some people view this as a competitor with like a NASDAQ realized vol product. I think it's complementary. You're going to see that S&P variance, you're going to see VIX futures, and I think that NASDAQ product traded off of each other in ways that where one OTC trade could theoretically ignite trades across the entire stratosphere, and you'll see, the realized vol contract used as maybe a better de facto gamma scalp contract for an OTC or a variance future. If the variance future is where they go to dump off the vol, the people that are buying that dumped off vol are going to need to scalp their gamma. The realized vol contract is going to be a much better product for scalping gamma than, say, a VIX future.
Yeah, and also then the variance contracts, simply because they've taken the variance contracts out, probably because of the unspeakable margin requirements that would be associated with a shorter dated contract of a 1 month or a 3 month. So this is like a 1 year product now, and that takes a little bit out of the sting out of the potential for margin requirements, but it also takes some of the potential for the kind of movement that you're talking about. And of course, we're envisioning the other end of the spectrum, where real vol futures will actually be probably most popular and most successful as a 1 month and a 3 month product, if not even weeklies that will come out. So basically a different type of term structure as well.
Yep.
Speaking of term structure and skew in general, our next question comes via the Twitterverse, and it's from Man of Steel. Another great Twitter handle here. Got some great listeners out there in the audience, Don. And he writes, what do people mean by, quote, selling or buying skew? What are those trades? Well, Man of Steel, there's a relatively, you don't hear that much anymore in the marketplace, but what the typical convention is when they say that is they usually refer to the put wing as the leading edge of that trade. So in a typical, we just talked about collars earlier. Of course, in the collar, you're buying the downside put, typically selling a call. That would be because you're buying in the put wing, you're buying skew. Vice versa, if you're doing a risk reversal that sells put and buys call, you are typically selling skew, and that's the convention most people hold by. You don't hear that bandied about as much anymore. Don, is that the way you looked at it when you were on the desk in Morgan Stanley back in the dark ages?
I thought you were going to say, you didn't have any skew because you were there before the crash.
You were pre-87. You couldn't buy or sell.
Actually, when you consider the both sides at once, so that you've got the out-of-the-money puts or the below-the-current market options, puts and calls, at higher implieds and above the market at lower, then certainly one way to measure that discrepancy, if you will. Some people look at the 90% option and the 110%, and they quote skew in terms of how many implied volatility points there is as a differential between the two. But you also can look at one side at a time, and let's say we look at the put side or below the market. There is a skew all the way down the entire gamut of strikes. Even if you start from where we are and just look at the below side, each strike that you go lower carries a higher implied volatility for the particular options that are associated with that strike. So another interpretation or possible concept of buying or selling skew is simply putting on some sort of a trade or a spread where you would either profit from a widening of that skew from strike to strike as opposed to a narrowing. So we talked a little bit in the past weeks about Taleb and hedging his straddles with back spreads and what have you. So a back spread with puts would be selling a strike that's closer to at the money and also with an implied volatility that would clearly be lower, and buying strikes that are below that and at higher volatility. So you might say, gee, why would somebody want to do that? You're buying higher and selling lower. Well, your outlook could be that the skew was going to steepen, that actually the out of the monies that you owned would have even higher implieds still going forward, whereas the one that you sold might stay the same or conceivably even go lower, and that would be consistent with what we call a steepening of the skew and of the curve. And of course, somebody who takes the other side of that trade is thinking in just the opposite manner. He's thinking about the skew flattening or becoming less steep, where if you sell those out of the monies at a higher implied volatility, you're hoping that that implied will drop even more. Whereas if you buy the ones closer to the market, you're hoping that maybe they will go up as that whole curve flattens a little bit. And that's another interpretation of what we might mean by buying or selling the actual skew itself and the relationship among the strikes.
Indeed. Like I said, it's an interesting term. You particularly don't hear retail use it that much. You still hear some institutional guys say it every now and then. Yeah, I was buying some skew out here. I was selling some skew. But yeah, not as often as it used to be. Maybe because I was just trading so many risk reversals back on the floor, so we use it quite often. But yeah, not so much these days. Next up, we have a tweet from VIXen, and so a little play on words from one of our listeners here, who is obviously a Vol fan. He writes, "Why are iron condors so hot right now? Seems like everyone is selling them these days, no matter the vol landscape." And VIXen, you should have been on our Option Block show just yesterday. We discussed this topic at some length.
Oh, iron condors.
Yes, it seems in the last couple of years, especially, iron condors really seem to have just become the trade du jour. Newsletters have sprung up. All sorts of services have sprung up. It's just the hot topic, the hot trade.
Do you want to know why iron condors are why newsletters love iron condors?
Why do newsletters love iron condors?
Because they can claim, we win 9 out of 10 of our trades.
Yeah.
Well, you want to know why? Most iron condors have about a 90% chance of working. So, it's a great way to say, hey, look, we win most of the time, without really revealing that you really have zero thought to your trading. And it is a trade that is pitched as an easy win that is much more difficult and lacks all of the edge in the strangles that Don was earlier talking about selling. Because you're selling a vol and then you're going out and buying a more expensive vol that is very close to it. So you don't get that same kind of edge in selling volatility risk premium that you might get. There are very few people that do it right. One person I would say that does do it right is a recent guest, one Jared Woodard, who knows his stuff.
Yes, we have to, of course, tip our hat to Jared, who was just on the show recently and has indeed made a name for himself in the condor space. I would certainly...
Taller than you would imagine.
Yes, he is taller. You're right. He comes across as a very subdued, smaller fellow, but he is lanky. I think lanky is a good way to describe him.
I think we should always take like a quick step backwards, because although we have a very sophisticated audience and many of our listeners know exactly what the trade is or what the position is, some may not be familiar. So just very quickly, I've often joked that the butterfly is a short straddle for cowards, and so the iron condor is a short strangle for cowards. And
yes, it is.
Or alternatively, a butterfly with a flat head rather than a pointy head. So basically, the concept is simply selling an out-of-the-money combination, or an out-of-the-money strangle, as it's referred to, out-of-the-money put below the current market, out-of-the-money call above. You choose your strike prices, you collect the premium, but then you're sitting with the typical strangle profile, which is potential for large or, at least on one side, infinite losses, cataclysmic on both sides. So the way you sleep better at night, placate your risk manager, is to go below the sold put and buy a farther out of the money one, above the sold call, buy a farther out of the money one, and therefore make that portion that was going down flat, so that in the event of something untoward, you can't have those catastrophic losses. As Mark just said, one of the problems with doing that and spending that extra premium is it cuts into the premium that you have sold. So every time I looked at doing something like that, I would sell my strangle, and then I'd consider, paying something for these way out of the money options. And my conclusion would always be the same. Let's make believe we did, but don't. And so I never spent the money for the out of the money ones. And yet, again, for risk management purposes and for sleeping better at night, obviously there's a place for it, but it has to be done in a skillful manner. And Jared seems to have a handle on it, but as Mark mentioned, it's not all that easy, and so it's not like you're just coining money.
And I think the topic that VIXen is referring to here, and especially, is these things have grown in popularity to such a degree, and there's so many services and newsletters out there pushing them, particularly on the selling side of the equation, that we've seen a very dangerous spin-off of this, is that they're starting to force these trades in environments where they're clearly not favorable for writing iron condors, but you've got a newsletter, you got to put out a trade every week or every month, whatever the case may be. So they're starting to force these trades in all kinds of obtuse scenarios that really are not at all favorable for writing iron condors. I think that's the main takeaway I would say to all of our listeners out there, and hopefully they're savvy enough to know this already. But so many of these services, when they're just out there doing one strategy and one strategy only, and they have to keep generating trade ideas, otherwise their subscribers dry up, they're putting out recommendations that really don't meet anyone's clear risk-reward profile, I would think. So keep that in mind when you're writing tons of condors and these names with the vols just come off atrociously, and you're still trying to force these trades.
And I would remind everybody, even Don, anybody who goes out and says, you can methodically sell a condor at 60 days or 45 days or whatever and do it every month and make a lot of money at it. All right? Don may not have bought a lot of options in his career, but he definitely understood when not to sell them. And and anybody that does not preach that there are times where options should not be sold is a crook and a liar. All right? And I think even if you never buy an option, you should understand why you never own one.
Yeah,
why you wouldn't sell it.
And I agree with that. And it's absolutely untrue that you can do this month after month methodically and just, say you're going to ring the cash register, because if it were that easy, my comment that I always have when I lecture about options is, who's the dope on the other side of the trade? Right. It isn't just that. Here's the right way to, like, good cholesterol and bad cholesterol. Here's the right way to do it. Here's the wrong way to do it. Well, if it were that open and shut, who'd be the idiot who'd step up to always do it the wrong way? So, it can obviously make money both buying and selling them. There's timing issues. There's strike price issues. There's volatility environment issues. And you can't go about it blindly and say, just write me a check.
If I had a nickel for every service I saw recommending short iron condors in Apple when the stock was around 680, 700, I would be a wealthy man right now, even far wealthier than I am today. And so yes, that's just the most recent example of people really trying to force these in environments that certainly were not favorable in that one. Next up is an email. I got a feeling you're going to like this one, Mark. It's an email from Sam Fellis, let's go with Fellis. He writes, why is the front month VIX future trading above the cash right now? I need the vol views pros to explain this to me. And since we've hit on this several times in the show on the past, including just recently on the option block, Mark, I'll let you run with this one. Obviously, last night's aberrant activities excluded. We have seen this strange near-term term structure here.
It's not right now. But the short answer is that it's a European-style contract and not an American-style contract. And there's this assumption of volatility mean reversion. And so when the cash VIX is trading at a discount to its long-term mean, there is an assumption that there is a gravitational pull for volatility to creep higher rather than lower. Since you cannot immediately exercise a VIX futures contract, and the VIX futures contract is in essence a forward volatility, the estimate is that volatility will in fact increase and will eventually hit that mean price, and thus there's kind of this gravitational pull between the VIX futures and the VIX and the regular VIX. Now, one thing I can't explain, Don and I have both failed to explain this, and I can't figure it out. Why is the August future trading 23%? Your guess is as good as mine. And the words of the great and wonderful Don Schlesinger, sold to you.
Yeah, I wonder if it's somehow or other just stale and people aren't paying a whole lot of attention to it. I don't know what kind of volume you can get in these contracts, but when you see those kinds of numbers with absolutely nothing to argue for why they should be like that, sometimes when I used to do that, I used to try to get a trade in, and they tell me, "Oh, gee, the screens are stale. Let me adjust my screen." So I never got my trade off, but I managed to fix a lot of faulty quotes in time. But I'm assuming you could actually trade this one. I'm assuming you could actually trade this one, and it surely doesn't make a whole lot of sense.
So there you go, listeners. One final time here in 2012, we were discussing and explaining the term structure of VIX, in particular some of the interesting developments we've been seeing on the very near term of the VIX curve. We haven't seen that much this year. In fact, it's been a very recent development. Usually we're talking about that long-term term structure being a bit out of control, but now we have some fun stuff to discuss here in the very, very near term as our good old friend mean reversion kicks in yet again. Last up, we have a question here for Don, a tweet from Sam Dash. He writes, Don, sell or don't sell vol in 2013? Give me your thoughts. And that's a very broad question.
That's the silliest question. I can't believe
that's why I like it. I want to hear what Don has to say on that one. Sometimes a silly palate cleanser to end it off is a good one.
I actually have a kind of a multi-tiered answer to this. So assuming that we're going to have our real vol futures contracts out there and trading for the coming year, the first thing is just trade volatility one way or the other. Trade realized, trade it against the other products that are out there, and go out and try to make some money. I'll differentiate, if you will. I'm not going to speculate on VIX, and I'm not going to speculate on implied volatility. As Mark said at the top of the show, I'm not a big fan of it. I have enough trouble trying to predict what's real and can actually be measured, trying to predict what other people are going to predict, and the element of human emotion that comes into VIX trading, as Mark commented at the top of the show about what happened overnight, basically is something that's fraught with all kind of danger. On the realized volatility front, I probably am on safer ground in predicting that at the levels we are seeing right now, it's probably more prudent, if you're forecasting for an entire year, to say that we're going higher for the very mean reversion fact and concept that Mark just brought up. We've got 1 month volatility under 10. We've got 3 month just a tick over 12. And we've got the entire year's volatility, looking back to the same date last year. Over the entire year, S&P volatility has been 12.72 for the year. So historically, that's a pretty low number. And if I were forecasting, or if our friend Professor Robert Engel at the Volatility Institute at NYU were forecasting, indeed his 1 year number is 15.87, which is precisely 1% a day. It's basically the type of movement that would be associated with averaging 1% movement a day on the index. So from a long-term perspective, I would have to say that the coming year will have realized volatility somewhat above what we have just seen.
Well, Don, here's the one thing I'll say, and you say buy or sell, okay? And I know the answer already. I can sell the SPX Jan 2014 1650 call at a 15.1 vol and collect about $16.50. Then I can go and sell the S&P 1000 put at an implied vol of about 27% and collect about $18.50. All right.
Can I hang up now so I can put my order in? Because I haven't been looking at these things lately the way you do, but you just brought me back into the trading desk again. What in for me for the new year, Mark?
There you go. I think that's a great ending point for our listener mailbag. I want to thank all of you listeners who wrote in this year and helped make VolView such a great interactive program. We love to have your feedback. So by all means, if you haven't joined us in 2012, then shoot us a question or a comment here for 2013, because we love hearing what you guys have to say and what's top of mind for you, the listener. And now we're going to dive into our final segment of 2012. This is, of course, our crystal ball.
And now we take a look at the crystal ball.
All right, and welcome to the crystal ball segment. This is, of course, where we peer deep into the murky ether to attempt to divine what the volatility gods hold in store for us for the rest of this year into early next year. And Don, I'll let you go first because you've already somewhat hit on this in a much broader perspective with our final question there in the old listener mailbag. But now, obviously looking at a much nearer term than all of 2013, we obviously have a very binomial situation out there in Washington right now, as we saw aptly demonstrated last night. So a little bit of interesting developments on the horizon for the next couple of weeks. Give our listeners your final summation here going into the end of 2012, early 2013, until we resume. By the way, I should let our listeners know this, like I said, this is our final show. We'll be back early next year. So this is going to be it for the next couple of weeks, Don. So what do you want to leave our listeners with from a vol perspective?
If at first you don't succeed, try again. I'm going to try the same thing that I said last week. It wasn't correct for the week that just passed. Perhaps it will be correct for the next 2 or 3 weeks. Realized volatility higher than it is right now on the major indices, VIX, and implied volatility lower than it is right now. The spread between the two to narrow as we eventually get some sort of resolution to what's been going on, and implieds come in, but perhaps realized, which are so very low right now, tick up a little bit as they head back towards a more normal level or to the historical means.
Yes, once we get this quote-unquote cliff sorted out, we may be in for some doldrums for the early part of next year. Mr. Sebastian, I know you've been leaning that side of the fence for a while now.
Mm-hmm.
You still leaning that way for the next couple of weeks into the new year?
The VIX Jan futures contract is trading $18.60. It is a sale. That is my prediction.
There you go. All that near-term bid up creates some juicy opportunities when you're talking about near-term volatility. You're right, because unless we saw some dramatic developments last night, we probably might see 1 or 2 more perhaps before all this shakes out, and then we're probably in for some very, very calm waters unless Europe decides to melt down again or something else happens on the near term that really shakes up the volatility spectrum. I'd imagine some of our early shows in 2013, we may be discussing more, shall we say, substantially south of 10% realized vol numbers in most of the major indices. Hopefully I'm wrong. Hopefully something happens to shake us up, but we shall see. And of course, with that, that's going to draw to a close our final segment of the year and also draw to a close another year of Volatility Views programs. I hope all of you, the listeners out there, really enjoyed the just amazing array of guests that we brought your way in 2012. We've already got some great ones lined up for 2013, and there will be more on the way. Of course, more interesting discussions about fascinating topics from the world of volatility. We have a lot of good stuff on our plate, and I hope you'll join us again in the new year. And before we go, I also want to check in with both of you, my cohorts here on the Volatility Views program, to see what you have in store for the coming year. Mark, we'll start with you. I think yours is a little bit easier to hit upon. What is coming up in the early part of next year for optionpit.com?
Oh, lots of things. We got lots of webinars coming up. We've got lots of other things going on. It's just an all-out great time. Hey, Mark, when does this come out? On the 24th?
Oh, I guess we were planning on putting it out Monday. I hadn't thought about that. That is actually Christmas Eve, but I guess we'll put it out Monday morning, yeah.
All right, well, so this comes out Monday morning. Through Christmas, we're going to let you buy our silver course for $17. So through the end of Christmas, through the 26th, all you have to do is it'll be $17. Actually, you know what? What's the price of the VIX? So it'll be $18. and
VIX
Don's
cash
honor,
pricing. I like that for your courses.
We're going to do VIX pricing. The VIX is trading $18. And the code to get that $18 price is going to be Don S1.
There you go,
all
listeners. Right. VIX cash pricing for all of your option pit classes, or the gold course, you said.
And that is for our silver course. And that is through, we'll make that good through Friday, through the 28th.
There you go, listeners. Get in while the getting is good. Or maybe you want to wait a couple of days and let the VIX cash crater, and then you get a bargain basement.
Well, no,
$13.
The price has been locked in now. The swap's in now.
I know some of our savvy listeners I'm going to hold out till Thursday, see what I can get. But that's a good deal. Take it.
It's not a forward contract.
Yes, one-time offer from Mr. Sebastian. So there you go, listeners. Surf on over to optionpit.com. Use that promo code DONS1. And you will have VIX cash pricing as of today, our recording and Friday. So good stuff there. And last but certainly not least, Don, I know you guys are really looking forward to 2013. Could be the year where you shake up everything. So give our listeners one final tease of what you have in store for the coming year.
Well, what I hope we have in store is an announcement of a partnership with a household name and a wonderful partner, perhaps even several, for our future endeavors with VolX, bringing out of our realized volatility contract futures on the NASDAQ and perhaps an S&P based product as well. More guests for the show. I'm rather proud of the fact that we've actually done 75 shows before today. We did 2 sneak previews, and we've numbered 73 episodes before today. And on fully 36 of those shows, almost 50% of them, we've had a guest. And I hope that the listeners have found that concept interesting and informative. We're going to continue to line up the guests in the future and try to make the show as interesting and as entertaining for as broad a listenership as we possibly can. So I'd like to take the opportunity to thank everybody who has listened over the past, about year and 9 months. It's hard to believe, but 25 more episodes or so, maybe the middle of next year, we'll have to have a big bash celebration for our 100th show.
We'll have to do a live show somewhere or something.
Yep, that would be great. So again, thank you for all of your support. Merry Christmas, happy, healthy, and prosperous New Year to all of our listeners, and we'll be talking to you after the first of the year.
Hard to believe it's been a year and 9 months, Don, since you and I first sat down at those croquet courts there in Boca,
That's right.
sunny Boca, to begin the adventure that would become Volatility Views, and quite the adventure it has been. It's been just a fantastic ride. Of course, if you want to go back and check out any of those 75-plus episodes that Don just mentioned, you can find links to them on volx.us. You can, of course, find them on the optionsinsider.com, or you can just subscribe to our shows on iTunes or Stitcher or any of the other leading outlets, and you find all of the episodes there. I encourage you, as we're on hiatus for the next couple of weeks, and perhaps you have some alone time on your hands or some time with family and you want to get away, then by all means, dig into the Vol Views archives. There might be some juicy nuggets there for you to enjoy over the coming weeks. And indeed, you can find those programs and all of the other programs we have on the Options Insider Radio Network over there at theoptionsinsider.com, as well as a lot of great information and news and other analysis for you to enjoy over the coming holiday season. So, of course, I want to join Don and Mark in thanking all of our listeners out there for downloading and streaming and subscribing to this program and making it such a great year for Volatility Views. And we'll see you all right back here in 2013.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.